You ever look at a city skyline and wonder, what makes all those cranes suddenly appear, or just as suddenly disappear? Well, it's not just about demand. There's this kind of hidden number, an unseen force that's really pulling all the strings. And that's what we're digging into today, replacement cost.
Okay, so let's just start with a quick thought experiment. Picture a big, shiny office building in the middle of your city. Now imagine, poof, it's just gone overnight. The big question is, what would it actually cost to rebuild a brand new version of it right there on that exact same spot? That simple question. That's the whole key to this thing.
And the answer to that question? Well, that's what we call replacement cost. Now, the key phrase you really got to latch onto here is equal utility. We are not talking about building a perfect, painstaking, brick-for-brick historical replica. Nope. We're talking about building a structure that does the same job, serves the same function, but, using today's more efficient materials and methods.
And this is a huge distinction. So let's be clear. Replacement cost is all about modern function. Reproduction cost, on the other hand, is a whole different animal. That's about making an exact copy, right down to the old-fashioned, maybe even outdated materials. It's basically the difference between building a modern, efficient car versus trying to build a brand new Model T from scratch. One's practical, the other's a museum piece, and it's going to cost you.
All right, so we get the concept, but what are we actually adding up here? What really goes into this big number? Well, it pretty much boils down to two main buckets, the stuff you can literally touch and all the invisible stuff.
First, you've got your hard costs, and this is exactly what it sounds like. It's the hard stuff. The steel beams, the concrete, the glass, the wiring. If you can walk up and kick it, it's probably a hard cost. It's the physical building, plain and simple.
And then you have the soft costs. These are the sneaky ones. They're absolutely essential, but you can't see them. We're talking about the architect's fees, the mountain of permits you need from the city, the lawyers, the loans. Oh, and yeah, the developer needs to make a profit too. It's so easy to forget this part, but get this. Soft costs can easily be a quarter, maybe even a third of the entire project's price tag. It's huge.
Okay, so with all these variables, you might be thinking, how on earth does anyone calculate this without a supercomputer? Well, for a quick back-of-the-envelope calculation that's still incredibly powerful, professionals have a go-to trick up their sleeve.
Yep, pretty much everyone in the business starts with the cost per square foot approach. It's dead simple. It's just basic multiplication, but man, the story it tells is anything but.
Let's make it real. Say you've got a nice 50,000 square foot office building, and let's say the going rate to build something like that is around $350 a square foot. You just multiply those two numbers together, and there you have it. Boom, $17.5 million. That's your replacement cost.
But, and this is a big but, that cost per square foot number is not one size fits all. A giant, simple warehouse? That might be, $100 a foot. A fancy high-rise in the heart of downtown? Whoa, that could easily top $800 a foot, maybe even more. The type of building changes absolutely everything here.
Okay, so this isn't just some abstract number for architects and insurance folks to argue about. This is where it gets really interesting, because replacement cost is one of the most powerful tools out there for figuring out what a property is actually worth.
And it all comes down to this really simple, powerful piece of logic. Just think about it for a second. Why in the world would you pay, say, $20 million for an existing building when you could literally build a brand new, shiny one right next door for only $17 million? The answer is you wouldn't. No one would. And just like that, replacement cost creates this sort of natural price cap on the market.
This is the core idea behind what appraisers call the cost approach. It sounds fancy, but it's really just three logical steps. Step 1, figure out what the land itself is worth. Step 2, add the full cost to build a brand new building on it. That's our replacement cost. And then, step 3, and this is the kicker, you have to subtract value for all the age and wear on the old building.
And this approach is a total lifesaver when you're dealing with unique properties. Like a hospital or a school. How many of those sell each year? Not many. So you can't just look at recent sales. It's also the absolute go-to for valuing brand new construction and, of course, for figuring out insurance payouts.
All right, let's circle back to that super important third step, depreciation. Because let's be real, a 30-year-old building is not worth the same as one that's brand spanking new. And appraisers have 3 different ways they account for that loss in value.
First up is the one we all get, it's just common sense. Physical deterioration. This is literally just stuff wearing out. The roof is getting old, the HVAC system is on its last legs, the carpets are totally shot. It's the price of time and use, plain and simple.
The second one is a little more subtle, functional obsolescence. This is when the building is physically fine, but its design is just outdated. The classic example is an old warehouse with like 18-foot ceilings. You can't stack things as high. It's just way less useful and therefore less valuable than a modern warehouse with 32-foot ceilings. The design just doesn't really function well for today's world.
And the last one, number 3, is external obsolescence. This is the tough one, because it's about stuff happening outside the property that you have zero control over. Maybe the city rezones the area, or a giant factory that employed half the town suddenly shuts down. Your building didn't change, but its value just took a hit anyway.
Okay, so we've been deep in the weeds. Let's pull way, way back now. Because this isn't just about one building's value. This single number has massive ripple effects that shape entire markets, from how insurance works to why our cities look the way they do.
And you see this play out big time with insurance. If you have a replacement cost policy and your building burns down, you get the money to build a new one. Simple. But if you have an actual cash value policy, you get the money to build a new one minus all that depreciation we just talked about. That gap can be enormous. We're talking about a difference that could literally put you out of business.
And this right here, this is maybe the biggest idea of all. It's the engine that drives the whole real estate cycle. When the price people are willing to pay for existing buildings goes above what it costs to build a new one, what happens? Developers see a green light for profit and bam, construction cranes pop up everywhere. But the moment those market values dip below the replacement cost, construction just stops, dead in its tracks. It's really that simple.
So you see, replacement cost isn't just some boring accounting figure on a spreadsheet. It's a flashing neon sign for the entire market. It's the key indicator that tells developers when to build and when to just wait it out.
So the next time you're walking around and you see a construction crane looming over the skyline, you'll see it differently. You'll know the real economic story it's telling. You'll know that for that one project, on that one specific spot, the scales have finally tipped, and the market decided it's worth more to build something new.